Ever wondered what it really means to own a piece of a company? Or why stock prices rise and fall every day? Let's break down how the stock market really works. In today's episode of Defy Vault, we'll explain what stocks are, how they function, and why understanding them is essential for both traditional investors and crypto enthusiasts. If you want more tips like this, make sure to hit that subscribe button right now. It really helps the channel grow, and you'll keep getting fresh crypto insights and updates in the future. Welcome to a journey where we're going to explore the world of stocks. Unraveling the complexities of the stock market can often feel like being lost in the labyrinth, but rest assured, by the end of this video you'll have a handle on the basics to understanding stock and how they work. You don't need to be a finance guru or a Wall Street insider to understand stocks, you just need to be curious and willing to learn. So, let's get started. At its core, stocks represent a slice of ownership in a company. When you purchase stock in a company, you become a shareholder in that company. This means you effectively own a small piece of the company's assets and have a claim to a portion of its future profits. It's kind of like buying a slice of a pizza. The more slices you have, the greater your share of that pizza. The same principle applies when you own shares of a company. The more shares you own, the greater your stake in the company. Companies sell stocks in the primary market to raise money for growth, research, or new projects. In the secondary market, regular investors trade these stocks with each other. Here, prices move up or down based on supply and demand, how many people want to buy versus how many want to sell. Owning stocks lets you earn money in two main ways: stock value growth and dividends. Stock growth happens when a company does well, making its shares more valuable. You can then sell your shares at a higher price than you paid, which can give you a profit. Dividends are regular payments that companies give to shareholders, usually as cash or extra shares. But not every company pays them. Some businesses choose to reinvest their profits instead, using the money to grow and expand for the future. Stock prices are dynamic, influenced by various factors, including company performance, economic conditions, and market sentiment. The biggest driver is demand. If more people want to buy a certain stock than those willing to sell, that stock's price can increase. In contrast, if more people want to sell than buy a stock, the price could decrease. Let's look at some key terms. A share is a single unit of ownership in a company. The more shares you own, the bigger your claim to the company's profits and assets. Dividends are special payments some companies give to shareholders, usually from their profits. Think of them as the cherry on top of your ice cream sundae. But not every company pays dividends. For those that do, payments usually come every few months or once a year. A bull market refers to a market phase where stock prices are rising, or are believed to rise. Investors are generally optimistic during a bull market and are more inclined to invest in anticipation of increased returns. On the flip side, a bear market denotes a downturn in the market, where stock prices are falling, and economic pessimism is the prevailing sentiment. Most investors are cautious during a bear market, looking for defensive strategies to protect their investment. Investing in stocks can help you grow your wealth over time, but it also carries risks. Stock prices can go up and down, and you might lose money if your investments don't perform as expected. Spreading your investments across different stocks and understanding the market can help reduce this risk. Investing in stocks isn't just buying and selling pieces of a company, it's about believing in the company's future. When you buy stocks, you become a part owner and share in the company's success. The choices you make when buying or selling stocks affect both the company and your own financial future. The basics of stocks are similar to another popular investment, cryptocurrencies. While stocks and crypto have key differences, like rules and regulations, both are ways to invest, including in digital platforms. This begs the question, why do people invest in the stock market and cryptocurrencies? For starters, stock investing and cryptocurrency investing present opportunities for potentially high returns. In recent times especially, they also offer opportunities to individual investors who may not have had a way to invest in broader markets. Investing in stocks and cryptocurrencies can be like venture capital. In venture capital, investors buy shares in a private company at a low price, hoping the value will grow a lot. This potential for big returns represents the risk investors take, which is similar in both venture capital and regular stock or crypto investing. Another reason people invest in stocks and cryptocurrencies is to protect against inflation. Smart investing in these high return opportunities can earn more than keeping money in a low interest savings account or fixed deposit. To sum up, stocks and cryptocurrencies share numerous features. They are both instruments of investment that present opportunities for potentially high returns, enable venture capitalism, and can be used as a hedge against inflation. An understanding of the functioning of these investment tools is essential for would-be investors. Oh, what are stocks? How do they work? And why do people get so excited about them? While the history and valuation theories of stocks are complex, the main idea is simple. The stock market lets businesses raise money, investors buy parts of companies they believe in, and it helps capitalism work smoothly. Stocks have helped the economy grow and let people own parts of successful companies. Every publicly traded stock represents a piece of a company. That company could be a small startup with great growth potential or an established blue-chip company with a record of strong performance. Ultimately, the stock market isn't a casino, it's not a get-rich-quick scheme, and investing is not about chasing hot stocks. Successful investors don't worry whether it's a bull or bear market today, nor do they fret over short-term fluctuations. Instead, they keep an eye on the bigger picture, look for growing, profitable companies, and hold on to their investments for the long term. By now, you can see that investing in the stock market isn't hard or only for the wealthy. With the right knowledge and strategy, anyone can invest and own parts of the companies that drive the global economy. Every day, regular people are becoming smart investors, taking control of their financial future, and enjoying the rewards of their efforts. If you're new to the stock market, my advice is to start slowly. Do your research, learn as much as you can about a given company, and only invest what you can afford to lose. Keep a medium or long-term horizon in mind and don't get discouraged by short-term swings. By understanding the risks and potentially high rewards, you can make informed decisions that can change your financial future. And as you continue on your investment journey, remember that while making money is important, it's not the only benefit of investing. By buying shares of companies you believe in, you're helping to fuel their growth and success. You get to be a part of that. How great is that? As we wrap up, let's take a moment to appreciate the stock market's incredible power to create economic booms and busts, wealth and poverty, highs and lows, excitement and fear. It's a volatile, dynamic, and unpredictable game, but it's also one of the cornerstones of capitalism, the engine that powers the economy. As the day comes to a close, and the markets wind down, always remember the words of the legendary Warren Buffett: the stock market is designed to transfer money from the active to the patient. The more you learn and the more patient you are, the more successful investing in the stock market is likely to be. Remember, knowledge is power. In investing, every bit of learning moves you closer to financial success. Keep learning, keep growing, and keep investing.